Welcome to Swimming with Allocators. I'm Ernest Sweat, and each episode, Alexa Benz and I give you a VC podcast from the LP perspective. You ready? Let's dive in. So in today's episode of Swimming with Allocators, we had David York. He is the managing director and founder of Top Tier Capital Partners. It was an amazing conversation today where David, who's had about 40 years of experience in the space, spoke about why more than ever he's bullish on the venture capital asset class, also why it's a great time to look at secondaries, and how new allocators should approach the VC asset class. And with that, let's dive in. All right, welcome again to Swimming with Allocators. And today we're excited to have another amazing guest. We have David York, who's the managing director and founder of Top Tier Capital Partners. Top Tier Capital Partners is an experienced investment manager that has fund of funds as well as co-investor products based in the Bay Area. And so glad to have David you on, and we look forward to learning so much in today's conversation. Thanks for being here.
Thanks, Ernest. I'm really looking forward to speaking with both of you guys. Alexa and I, we've not met before, but it's a pleasure meeting you, and I'm looking forward to the conversation this morning.
Thanks so much.
First, to level set, David, I would love to hear about how you got to Top Tier and founding Top Tier. So could you just speak about your experience?
Sure, I'll be happy
in the
to
asset
share.
Class. Yeah.
The journey's been a little bit convoluted and somewhat unexpected. If you think about it, I graduated with a degree in industrial engineering at the time when interest rates were in the low 20s, and which was some time ago, and really became enamored with Wall Street and actually worked at an investment bank in Los Angeles. I went to the University of Southern California, and that's where we started our career. And then ultimately ended up running a business at Drexel Burnham in New York when I was in my late 20s. And that led me to working with private equity investors for the first time. Then moved back to California after a short stint with my family's business. I went back to Wall Street, ended up landing a job at Hambrick & Quist, which was a small boutique technology investment bank here in San Francisco. Mm-hmm. And I was responsible for covering the venture capital community, and that was my first real immersion into the venture ecosystem. You would call that responsibility a financial sponsor coverage business today, but we called it venture services. And our jobs were to attract as much deal flow to the bank as possible from that ecosystem, which included corporations, individuals, as well as funds and their limited partners. So I got sort of to see the whole ecosystem there. And ultimately, that led me to be recruited after H&Q was bought by Chase by one of my clients to help them institutionalize a fund-to-fund product within that firm. That firm at that time was called Paul Capital Partners. Most of you might not be aware of Paul. Paul was one of the leading secondary firms at that time, think late 90s, early 2000s. And the founder of that firm, Phil Paul, actually had a pedigree starting with running the family office in the 80s for one of the leading investors in venture capital, which was the Hillman Company. And he sat down at Sand Hill Road and was responsible for being the lead investor at places like Kleiner Perkins and NEA and U.S. Venture Partners and the like, helped Kevin Landry spin out TA Associates when he was at Advent. And a bunch of history like that really made essentially launching that product within Paul Capital much easier. So we took my relationships at Hambrick & Quist, which were many, as well as Phil's history, and that's how we got the firm actually started in 2000 with its first commingled fund of funds product. Prior to that, Phil had landed a separate account with the government of Singapore, which was the track record we leveraged to get the fund of funds product off the ground. And then as we went through the early 2000s, if you remember, venture capital went through a very long dry period. And at that period of time, we beavered away and continued to raise money in a way that was really driven by accessing top tier brands. Think of the very best venture firms in the industry. They were labeled as top tier firms. And our first account was called Top Tier Investments. Our second fund was called Paul Capital Top Tier Investments. And that's kind of where the branding came from.
Mm.
In the mid 2000s, we had the opportunity to start to become independent, which, frankly, the partners at Paul Capital applauded because they weren't very enamored with venture by that period of time. And we were very excited about what we were doing. And so we had a chance to start to spin out and ultimately became independent in April of 2011. And we spent a lot of time trying to figure out how to come up with a proper name. Phil Paul was the name of the prior firm, Paul Capital. We internally decided we didn't want to name ourselves after an individual. We wanted to name ourselves after a thing. And if you think about the 2010 timeframe, the internet had essentially allowed every river, stream, mountain, plant material you can name to be essentially branded as a financial sponsor activity. And so ultimately we owned the rights to Top Tier. And so we capitulated and took on that brand as our new firm name. And ironically, it's been quite beneficial in a way that we didn't anticipate. And it's been fun building the firm around that brand as both limited partners as well as general partners resonate with that descriptive. And it's been fun to kind of live up to the expectation of that brand, which is one of the sort of tenets of how the firm got built, was really providing good customer service. But that's how we got here.
Okay.
In the early days.
And you kind of mentioned it a little bit. Some of the partners at Paul Capital were less enamored by venture. What gave you guys the confidence to start, a fund-to-fund strategy alone that you felt that it could stand still on its own? And how does that strategy or how does that thinking and perspective change or been supported?
Because you mentioned early on, we now are in the co-investment business, and we're also in the secondary business. Technology continued to kind of reinvent itself. We were fortunate enough to be in the first Facebook fund at Excel. And so, we really had a very good understanding of what was going on inside our portfolios, and they were growing. And if you go back to the time when Lehman Brothers went out of business, nothing was growing, but technology was. And so we felt we had a hold of this valuable opportunity, even though people didn't really respect it, that was going to continue to do well, and we just needed to build a franchise around it. And the two tenets that we had early on around that franchise were customer service, both for our managers as well as our investors. And we set up sort of two different service problems to solve regarding our investors and our managers. And we've kind of kept that as part of our core tenets as we have grown the firm. And so we were about 12 years into that goodwill creation around those two tenets in a way that it really felt like that was also taking hold, and we didn't really want to lose or squander, those goodwill components that, frankly, are part of the firm's culture today and also part of the firm's franchise. And then, as we looked at the opportunity set, especially around the global financial crisis, we really thought secondaries were really something we had a different view on than most people. If you go back in that period of time, people were selling everything, and venture didn't really have any leg to stand on. And if you knew what was going on inside those portfolios, there were quite a few things that were working. So I remember one of our very first investments we did of material size in the secondary business was in a partnership that had actually gone through two key man transaction problems that we had been instrumental in fixing. And so we knew intimately what was going on there. The LPs, frankly, wanted to walk away. And so we ended up buying a bunch of those funds and actually tripling, and in one case, quadrupling our money in a secondary. And we thought, wow, this is performing better than some of our venture managers. Why don't we do more of this? And so we started to blend that strategy into our fund of funds allocations in a way that became about 20% of our portfolio. And the whole premise of that was to generate cash flow on the front end of those portfolios to allow us the time to wait till the actual primaries started to mature, which were typically, at early days, it would be year 4, but usually it was 6 or 8 years in, you'd start to really see the benefits of the primary investments. And so the secondaries were generating cash flow on the front end of that one, got us out of the J curve, but two, got our funds at 1.5, 1.6x very early on. in a way that it helped our performance. It helped us raise money. It helped with a lot of things. Helped with our preferred return. So that was really the motivation to really start to build our secondary and co-investment business. Co-investments came a little bit after that, and that was driven really initially by Sequoia's Black Monday PowerPoint after the global financial crisis, and general partners trying to figure out how much capital they needed to keep their companies alive, and essentially coming to their limited partners and us in particular and saying, hey, if you could you put a little bit of money aside to help us have enough reserves for these companies? And so that was the impetus to start our co-investment business. There were some fits and starts there. I would say early on we had some lessons learned, but today that's a very successful part of what we do. And we think of this as twofold. One, a way to generate exceptional returns for investors, but two, also to provide that value add service component to our underlying managers in a way that we can help them not only with their LPs, we help them with some of their GP problems. We also help their companies with late stage capital in our co-investment activity. And so that's how the firm has evolved. And that's really what's been the motivation of us doing kind of a full stack solution for the industry. I don't know if that answers your question, Ernest, but that's a lot of information.
No, I am curious compared to that Sequoia, that moment, that email, how that approach to secondaries and co-investments and even your fund of funds. Do you see a lot of parallels right now, or how are you thinking about things differently?
Yeah, of course, lots of people are asking me that. For better or for worse, I'm one of the few people that's been. This is just starting my fourth decade, so we've seen various things. When I was at Drexel, I literally was sitting on the trading desk when the market corrected 25%. What's different today, and I do think it's different. There's several things. One of them is this technology consumption and the comfort with technology consumption has been materially changed by COVID. So coming out of global financial crisis, coming out of the internet bubble in particular, those two corrections, technology still was a nice to have, not a need to have. And today that's a need to have in a way that, my dad uses Uber. He's 86 years old. He actually bought some Uber in his stock portfolio because he wanted to support, that's something that you didn't do in the global financial crisis. And you certainly didn't do it coming out of the internet correction. So I really think we're sitting in front of a technology cycle that's going to be driven by comfort and consumption. And then on top of it, what I would argue is kind of a massive rebuild of the technology stacks that we've been comfortable or we've spent the last 30 years building. And so historically, those have been great times to allocate because you get to build a position through a correction. It's usually 2 or 3 years of position building. And then you're really in a position to win as opposed to wishing you'd started 2 or 3 years earlier. And this is the tricky bit about investors buying, as Warren Buffett suggests, when people are worried versus when people are greedy. And I really think this is this period of time. The other thing is materially different. Technology consumption's up, huge technology cycle in front of us. And then venture, to its credit, has continued to demonstrate statistically it's the best performing asset class in the equity ecosystem. So if that's the case, then you need exposure. And so again, I think it's a great time to be building exposure. If you went through the internet bubble and or the global financial crisis, that wasn't as obvious because one of the beauties of our business, which we talked about early on, is it continues to reinvent itself. And it wasn't quite as obvious in those two corrections that we were going to have the reinventions that we have today. And so I just, it's one of those asset classes that's has volatility, it's ups and downs, but if you're not in it, you're not going to actually have the benefits of being in it. So you just need to participate. You need to find managers you trust. You need to find folks that have the sneaky sense of looking around corners. And there's lots of reasons why they can do that. Some of it's just the person, but those things really, I think, set you up to win, especially in these types of environments.
The secondary market is something you know so well, and others are just sort of realizing, oh, this is where I should potentially be looking for deals. Is there anything that you see sort of allocators or even the media positioning that you just feel like better? Or
there's two things I would suggest there. So the reason the secondary market is interesting today is twofold. Valuations have corrected incredibly quickly. If you look at the global financial crisis, it was roughly 18 to 36 months. And during the internet bubble, the valuations corrected. It took about 3 years. And then it really wasn't clear for another 3 years whether that was where the correction was or not. So there was this long desert after the internet bubble. There was a relatively, 3-year-ish desert after the global financial crisis. Based on our reports and things we get from our managers, as well as what we know is going on in the marketplace, we're kind of bumping around a bottom today, and we do expect that there will be resets in pricing and valuation going forward, but it'll be market driven as opposed to just correction driven. A couple reasons is that inflation's been transitory; it's finally transitioned, and that then affects interest rates and expected rates of return in a way you can start to price things. And so companies will, when they go back to market to raise money, will be priced a lot differently. And if they're thriving, they'll be priced kind of rationally. If they're not thriving, it'll be work, and the work provides investment opportunity. As far as secondaries are concerned, the other component, so we've had this correction, but it's been quick. And then the other component is interest rates have really messed up investors' balance sheets. And it's not because they're getting a higher rate of return. It's because the fixed income portfolios and the other fixed oriented assets like real estate and infrastructure that sit on their balance sheets have been repriced because interest rates have changed the pricing of those assets. And so the asset allocation approach that most people use is out of schism. So to get that right, there's two things you can do. You can kind of slow down your commitment pace and hope that the market kind of pulls you through. Or if you can't afford that, then you have to sell some stuff. And one of the more liquid markets is the private equity secondary space. So, right now people are selling things because they need liquidity, and they're not going to go forward with the current batch of managers. There will be a period of time where they might have to sell stuff just because they have to sell stuff, and that's where you get distress in the marketplace. Right now, the distress is really around people that just need liquidity. And it's not as great as I think, over the course of the next 2 years, I think we're going to continue to see quite a bit of need for liquidity because people are going to come back to market and raise funds. Their balance sheets are going to be set up to support managers. The managers they want to support aren't going to have room for them. They need to be in the room to keep their allocation. So they're going to have to sell stuff to change that portfolio construction model in a way that fits what essentially, the people in charge want it to fit. So we think secondaries are going to have a lot of flow. That's providing, with this correction, price schism. Pricing today in the secondary market is between 40 and 60 off. Frankly, Q4 and Q1 valuations, which are pretty marked down. So you're ending up buying essentially at a discount to the discount in a way that we think it's a great time to be building a position. And that's one of the ways to do it.
How you mentioned a little bit about how the industry continues to evolve, and I'm just curious, over your top tiers time and your experience, how has that really influenced your way and even diligencing current relationships with managers as well as new? Because this game, as you mentioned, is about like being in it and access. But now we have way more firms, way more strategies, not to mention all the macro things you just mentioned.
Right. So if you look at our distribution profile over the last 20 years, like I said very early on, we were originally buying brands. We still have very, very large exposure to a lot of the branded firms. You'll find those on our website. But two things have changed. One is the cost of starting companies continues to go down. And it's today it probably costs anywhere from $0 to $2 million really to get a viable company up and running as well as a product started. And so that ecosystem really didn't exist 20 years ago. It now exists today because of technology, really. If you think about what Amazon's done to storage or Google's done to software. And so, that ecosystem is generating some very attractive, smaller firms that are really focused on the formation period of the company. And that formation period is where you get the best ownership and get the best entry price. And so as investors in this space, it's forced us to really think hard about how we want to have our portfolios constructed. And so we set aside about 20% of our portfolios for that type of manager. And then we set aside about 20% for what we call late stage investing, which is some of it's with managers, but a lot of it's with our velocity product exposure and some healthcare. And then the middle is really focused on, more of those branded firms or what we call our core managers. We do worry about fund size there. We've done a bunch of work around fund size, and it's clear if you want a 3X fund, you really need a company to deliver at least a fund returner or a fund to deliver a fund returner. The work we've done over the last 20 years would suggest, more than 85% of our managers that have 3X funds have at least one fund returner in that fund. And their ownership at exit is roughly around 10%. And so that math would suggest that you need a fund that's kind of less than $1 billion, more closer to 500 to really make that work. And so some of the large cap firms, I think, are going to have trouble with performance if their fund sizes get too big. And they kind of know it. And so it's not, they're going to have multiple outcomes to really generate a fund returner, and frankly, multiple outcomes to really generate 3X. And so it's something that we worry about and think about a lot. And so the seed managers kind of counterbalance that in a way that we like that ecosystem a lot.
To that point, looking at the emerging managers, and I won't share the name. I'll let you do that if you feel like, but you guys have done a great job of finding that next batch of great managers, not all at just fund one, but sometimes at fund two, fund three. Can you talk about that, your sourcing and diligence practices and how you're able to make those decisions on when to jump in?
Some of it's just tenure. We see 500 or 600 managers a year, and that generates its own flywheel. And then some of it's, if you look across the investment team, especially the senior members of the team, we've been in the ecosystem on average about 25 years each. And so some of it here and some of it at other places, but in general, that gives us also a flywheel of relationships. But usually what we do is we're really, most of the people we sponsor that are in funds 1 through 4, call it, and I'll describe the difference, but are folks that we have, through our networks, gotten to know, usually have some other track record. It could be their seed track record on their own. It could be their history of doing various things. But the component of those two things, our relationship and their track record, leads us to lean in. Sometimes that track record is just based on, gravitas of where they worked before and knowing where they worked before and who worked there, and we can back channel on whether it's credible or not. But that's how we get comfortable with leaning in. And then we spend a bunch of time in our network making sure that this is somebody that's going to go long. We're very much interested in helping someone start a firm and build a firm because we think, when we decide to invest, it's kind of for life. In a perfect world, it sometimes doesn't quite work that way, but that's how we approach it. And then, the reason sometimes we don't really lean in until funds 3 or 4 has to do more with how the manager is evolved. And so, I think the way I describe it is, if you look at the seed ecosystem in general, usually fund 1 is their own personal seed activity as well as maybe some seed activity with friends and family. Fund 2, and that's usually somewhere between 0 and 10 million, maybe $15 million. Usually it's less than 10. And that generates, a 6X track in a way that they're all excited. So they go out to their friends, actually their extended network of friends, and they raise a fund. It's maybe, say, if that first fund is 6 million, the second one is 15. And then it's off that 15 that they decide they want to actually do it for a living. And that's when usually they're looking for institutional capital. We usually like someone to be north of 50 to get started, because we want to commit, 10 to 15. And at that size, we can actually, that makes impact on what we're managing in a way that makes it's helpful. The work we've done on the right size kind of institutional seed fund actually is north of 100. It usually is kind of in the 125 to 175 zone, where they have enough capital to actually reserve and move into their later stage successful companies in a way that they can actually kind of double down on ownership and get some compounding around the portfolio that's working. And that generates more upside than just doing a whole bunch of bets and then doing another fund with a whole bunch of bets. We found that ownership at the end of the day drives, frankly, the best outcomes. And most managers that start by just buying a bunch of companies ultimately come back and say, I wish I had more ownership, and we're going to concentrate more in the next fund. And we want a little capital set aside to sponsor some of our winners, et cetera. And ultimately, lo and behold, they're worried about having 10 or 15% ownership, which wasn't where they started. They were happy writing $300,000 or $400,000 checks. So, that requires a little bit of scale and also a little bit of track record and a little bit of institutional rigor around reporting and kind of understanding you're in the asset management business versus just kind of that sexy guy in the corner with a wallet.
I think that's a great excuse for why you need to invest more, please, LP. Well, you would have been able to have more ownership.
Ironically, somebody starts to get really good at seed investing. You're like, damn, I wish I had more of that company. And guess what? If you got a bigger checkbook, you might. So that's how that kind of happens. They start to figure it out. It's almost, I can't think of anybody that hasn't ultimately come back and said they wish they had more ownership. I mean, one of the things that we learned actually, not going into COVID, when seed was kind of 6 to 8 years kind of a thing, if you were halfway decent at selection, you had an inorganic sort of step up of about 1.6x with the A round. And so there are a lot of guys who are like, look at my fund, I'm doing so well. And it's kind of like, yeah, that's because you're average. And so it's an interesting phenomenon with seed. But I do think one of the things that's happened today, especially because the large cap firms have gotten so large and they need to write such big checks, that seed is one of the places that you can actually demonstrate capital table control because the founder really, he doesn't know who to trust. And the guy he trusts the most, or the gal, is the one who put him in business. And so it is a preferred spot. It's just, it is tricky, and you have to have a kind of special approach to life to get to like it. And a lot of people do, but, and it's going to be competitive. I mean, just one final thing on that market. I do think we're going to go through a period of contraction there because there's just been a lot of people that have started firms in the last 5 years that are kind of excited about what they're doing, but they don't really have capital in their sort of viewfinder. If you think about the people that sponsored those funds early on and the like, and have lacking that capital, they'll have to reinvent their capital bases. And in this market, people are going to be a lot more picky about things. So I think we'll see some contraction there.
How do you think about your re-ups?
Well, we're spending a bunch of time really trying to understand the underlying portfolios. And then for better or for worse, through COVID, a lot of people got rich. And let's just be honest. There was a lot of money taken out of the ecosystem. I mean, even at our firm, we distribute, a lot of money. We distribute over $2 billion through that 2-year period from 2020 to 2022. On a base of about 5. So, there's a lot of liquidity. And so people are going to call in rich. They might not be admitting it this fundraise, but they really aren't the same person they were beforehand. And so we really tried to sort that out. And then we just want to make sure that the fund size and the strategy marry up with each other. We have seen some firms, admit that they're going to reduce their fund sizes, but we haven't. It isn't nearly as prolific as it was in 2003, where most people went from roughly $1.2 billion to about 300 to 400 million, which forced them to change their firms, the economics, how they're running their firms. And I'm not sure that's going to happen today, because I do think public markets still are reluctant to buy technology businesses that aren't profitable. And so venture and the growth rounds that capital is going to be necessary. So that's going to keep that activity going on for a long period of time. But I do think fund size is paramount as far as returns are concerned. So you're going to have to really understand how they marry up vis-a-vis the comments I made earlier.
In addition to the kind of like fund size as part of the strategy, what other strategies do you think is top tier really in favor of generalists versus specialists, or cross?
So there is a tug of war there going on, Ernest. You're right. Yeah. And the specialist will argue that the entrepreneur wants somebody to really, really focused on his ecosystem. The generalists will argue that we have 6 individuals here that are focused on ecosystems just as intently as that specialist. And I think they're a little bit right. What usually happens, and what's happening right this moment, is you kind of get a reversion to the mean, which is that capital will find comfort in diversification, as well as in a generalist who's an expert versus a specialist who's an expert, unless you have ecosystems that are big enough. We've done healthcare through our whole history, and that ecosystem as a percentage of GDP is, roughly 20%, and that continues to be a really large market in a way you can rationalize. I think you can rationalize a generalist. We didn't chase crypto per se because we were starting to get enough in our portfolios in a way that we wanted to allow it to become big enough. I think at some point it will be big enough. If you spend time with Chris Dixon, he'll argue that will be your next internet, and the internet will be what you do in your generalist funds. You know what I mean? We'll see. I mean, it's still early to tell, and obviously the regulators have a lot to say about that. But there are some ecosystems that continue to become, that are large, and you could argue a generalist would work, like the enterprise software space. You could also argue the cybersecurity space is going to continue to be a big enough ecosystem that could require an expert. But in general, if you think about portfolio construction and think about what we do, most of our managers have these experts, and a lot of our book ends up having those best companies in a way that I don't know if it motivates you to buy 12 specialists to get the same effect. And so that's the tension you'll see with institutional investors is, do I need a specialist if I can get a blend of that and a generalist, and have a portfolio of generals that give me the same sort of industry exposure? So that's why I think you need scale in these industries.
Generally, it feels like you were bullish in the past on venture when others were tucking their tails between their legs. What about now? Are there things to be optimistic and hopeful about? You're sort of mentioning some of these sectors, maybe healthcare.
Yeah. Well, Moore's law, is rampant as ever. And, at the time he coined that was 30, 40 years ago, 18 months of doubling was kind of a reach. Today, it seems like 18 months is a little slow. So if you want exposure to that kind of evolution, there's no other place to get it as an equity investor. Can't really get it much anywhere. And so it to me is part of your equity balance sheet, if you will. It makes a lot of sense to have exposure here. I'm excited about what's going on with AI. Some of it's because, if my David York, I'm happy to make money hat on, I think the whole technology stack gets reinvented in a way that is, as an allocator at the start of that, it's exciting. You're going to have the large cap incumbents control the data, but I don't think they're going to have all of the widgets that are going to make our world better. And if you get your head around what a co-pilot means, you can see co-pilots for everything. So I'm very excited about that. It was no different than what happened as we started to get social media into the enterprise and change the way we thought as far as companies were concerned, and kind of no different in how we thought about going to the cloud. So, so I get it, and that makes me super excited about buying in this correction. I do think it's going to change how we live our lives, and we just don't really quite know how. I do, there's some obvious places. It'll change how we do healthcare. I think it'll change how we do accounting and legal. It'll change how we drive. There's a lot of sort of obvious things. We'll have to think differently. We won't have to worry about, the 8 to 5 career. We'll have to worry about the career that's provocative. And, I think all of those things are very, very constructive and exciting. So, so I'm delighted to be investing in general, and then, we are fortunate and blessed to work with some really fun and interesting people. Ernest has seen some of that with us. And, those people are, all have certain traits. And so we're just blessed to be exposed to them. And then, frankly, want to help them get better at what they do in a way that we can get better at what we do. So we're excited about that stuff. Sincere, Alex. I know you're listening to me going, holy cow, you ought to have a church.
No. That's, you have to be an optimist to be in this business.
Well, I am. It drives my colleagues
No,
nuts.
you were right last time. So I think people should listen.
Now we're going to take a quick break to speak with our sponsor. On the show today, we have an industry expert and sponsor, Renuka Kumar, the managing director of investor coverage at Silicon Valley Bank's, a division of First Citizen Bank. Thank you, Renuka, for partnering with the show, and glad to have you today. So, Renuka, you lead the investor coverage group at SVB. How do you and SVB actually collaborate with VCs?
Yeah, so investors are the engine behind a lot of what we do at SVB. Given our unique positioning in the space where we have visibility into tens of thousands of clients and relationships with the most active investors, a lot of what we do revolves around insight sharing, community building, and working with their portfolio companies. We've always been known at SVB as kind of that one-stop shop for VCs, and that really looks no different today.
So you're having conversations with investors all the time on the regular. Is there anything you're hearing or gathering, information that you're gathering that might be counter to what people expect and see kind of in those macro trends and headlines?
Yeah. Well, you hear a lot of doom and gloom over the past year or so, especially coming off of 2021's exuberance. I would say that there's actually a lot more positive sentiment out there in terms of deals that they're seeing, deals that are getting funded. What we're seeing in Gen AI, of course, is truly transformational, and that has impact across sectors. But then there's also sectors such as climate and security, which are seeing a lot of activity. And I would say there's also this feeling of, I don't know, maybe it's relief, but that there's more normalcy in the market. We're not running at this unsustainable pace and, just playing catch up with the market. Investors are taking more time for diligence, spending more time with their portfolio companies, having more, in-depth conversations with the teams and thinking more strategically. There's more of a focus on unit economics and fundamentals. So a lot of these core reasons are why investors got into this business in the first place. So there's almost some, there's some positive sentiment around where the market is today in terms of that.
Yeah. Is there anything else to our audience of allocators, GPs, and emerging managers that you'd like to share?
Yeah, I would say, obviously there's been a lot of news around SVB this year, and we are now 8 months into the acquisition by First Citizens, and we're operating as our own standalone division, still known as SVB. We benefit from a strong balance sheet under the First Citizens umbrella, and we maintain the same commitment to the venture ecosystem that you've always known from SVB. As our clients continue to tell us, they have not seen any difference in our commitment to their companies and our offerings, and we stand ready to help you and your portfolio companies any way we can.
Renuka, you're such a great partner in the VC ecosystem. Thank you for partnering with us. For folks who are interested in getting in touch with Renuka and SVB, feel free to email her at rkumar, Kumar, at svb.com. And now back to our LP interview. One last question I wanted to ask was, you know, a number of our audience is from the allocator community.
Sure.
Those that have been experienced, those have been, you know, that are just entering in it. What advice do you have for them, especially if they're interested with all these things changing? They're interested in not just having the core fund to fund investment
Sure.
funds, but also this, you know, co-investor and secondaries. What advice do you have for them on how to build that expertise?
So there's 3 ways to buy venture capital. You can invest in a company, you can invest in a manager, or you can invest in a portfolio. If you're building a portfolio from scratch, the least risky is buying a portfolio, so therefore a fund of funds. The next least risky is buying secondaries in those funds. And the reason there's risk there is because the assets are mature and they're established. So you have to know what you're buying. With a fund of funds, you have to know the manager, which is in some ways an easier exercise. We like secondaries. The way we do secondaries is really driven by our data and our managers and the underlying portfolio companies. So today we have, I don't know, we've done something close to 600 different LP commitments over our history. These are buying, you know, secondaries and managers. You're buying primaries and managers. It represents about 185 different firms over our history. We track today actively about 250 firms. We are investors on average in our portfolios on average of about 25 of those. So lots of bars and things, but there's lots of data. And to have that data gives us essentially almost an insider view on what's going on and the stuff we're buying in the secondary market. So we've tried to take as much risk out of that purchase decision as possible. You can do that on your own, but I would argue that you need to really rely on your data and your relationships to have successful purchases. Or, you know, if you look at the buyout industry, a lot of the guys that drive the secondary market in general do buyout funds is because they own that company through somebody else in a way that have a good visibility on the underlying company they're purchasing. And then the other, you know, final way to do it, or the next level is buying managers. I talked about buying portfolios, buying managers. That can be a fool's errand sometimes because I don't know a secondary fund that you sit down with that doesn't sound sexy. So you can get lost in that charm in a way that you make an investment, it sounds great, and then 3 years in, it's a problem. And so that takes a lot of experience and time. So we tend to recommend new investors start with portfolios, and then part of our service is to help them develop direct relationships so that they can ultimately, if they want to, go off on their own. Sometimes they say they do, and then they don't. Sometimes they do. It just depends. And we've done that for most of our history in a way that we have quite a track record of that. And then finally, you can buy companies, and that's even more risky than buying portfolios or managers, because at least with a manager, you get 20 or 30 companies in a fund. And, you know, that's unless you're really informed, kind of a crapshoot. Now you can build a portfolio of companies in a way that, you know, 2 of the 20 you buy actually work in a way that you actually it has a reasonable rate of return. But it's I tell you, the brain damage in that is hard, and that's why people buy managers and in our case buy portfolios. So I mean, that I would recommend that walk: portfolios, funds, then companies, which is kind of how we walked. We started with portfolios, and then we started doing secondaries, and then we started doing co-investments. And then the other thing with venture capital is duration is your Achilles heel. And if you have to be ready for duration, and if you aren't, it can drive you and your boss crazy as you put money to work and don't see the outcome for 6 to 8 years. So you have to be set up for that too, which is sometimes why secondaries become more attractive, because the duration is about half as long as a typical fund is, or a typical portfolio of funds.
Now, you'll hear RIAs say things like, well, most of my clients don't have enough net worth to do venture correctly. Do you think that there's a healthy sort of number for when you're thinking about somebody playing in this space?
Yeah.
What percent does venture belong in your? San Francisco, every 30-year-old, every single dollar they have, they're putting in a founder's company.
Right.
So there's a lot of debate on that topic.
Yeah, and let's use just the 60-40 standard portfolio. So your 60% is equity, 40% is fixed income or flip, depending on who you are. But private equities today, if you look across, most ecosystems, is somewhere between 15 and 25% of that. And then if you look at institutions, private venture capital is another 15 to 25% of that. So blended basis, there some, on a high level, it's 10% of a portfolio, which would be 6%, 10% of an equity portfolio, which would be 6% of that 60-40 mix. And if that's $60,000, I don't know if it moves the needle enough to justify it. If it's $6 million, then it's something you should consider, or even, $600,000. But again, you've got to be in it for a very long period of time, and you've got to let it work for you. And that's sometimes hard for individuals to get their head on. It's sort of like if you invest in venture capital, it's like buying a house. You think you're going to be in there 5 or 6 years at least. And if you do it well, you're going to buy it 3 or 4 times. And so it's a 20-year-old house by the time it really starts to show up. And then it does show up. If you do a decent job, you should triple your money in a way that you're not going to really get out of other assets. So it's just, you have to have that frame of reference.
Yeah. So there's been over these last couple of years an influx of new managers from diverse backgrounds, from underrepresented backgrounds. How do you believe that's going to play out over the next couple of years, and what's Top Tier's approach?
So our approach to that ecosystem is actually not terribly different than our approach to our seed manager programs. I mean, we've been asked to consider minority-based investing for a very long time. A lot of our sort of emerging managers, if you will, our funds 1, 2, 3, 4, et cetera, have a very high concentration of minority-based individuals there. And, frankly, most of that is not intentional. Most of it is really intentional, trying to find the best people with the best track records that generate the best outcomes. What's been encouraging the last really 3 to 5 years, and, it's unfortunate the George Floyd passing really accelerated the whole problem around diversity in asset management and diversity around the founder ecosystem in a way that, what we see going on today is actually very encouraging. We've spent a lot of time in that ecosystem. We've spent a lot of time with managers and entrepreneurs in that ecosystem. We've sponsored several, and it's not because they're minorities, but primarily because we think they're going to actually be very, very good, successful investors or very good, successful entrepreneurs. What I see going on there, though, is, again, this embracing of technology as a way to stimulate economic growth, both for the founder as well as for the community, in a way that I just think that's inevitable. And we'll start to see very, very exciting companies coming out of that ecosystem in a way that I think it'll be a very attractive place to invest over the next 10 to 20 years. And I think it's also an evolution of the country. We're starting to really grow a very, very successful minority base in a way that I think that's just inevitable. In our manager base in general, the owners of our firms today aren't as diverse as the community would like, but I would argue that the principles, meaning the underlying individuals at those firms that are coming up through the ranks to ultimately, hopefully, run those firms are starting to profile in a way that I think the community will be happy with. It's just not as evident today. And then on the entrepreneur side, especially with women, it's sort of like there's no hold back. I mean, the women founders and the women community in general is just growing rapidly, and I think really creating some very, very exciting companies.
Yeah, we've seen a huge rise in the number of women graduating with technical degrees, and I think that will sort of pattern matches to a lot of what people typically look for in.
And we've seen the same thing in general partnerships. The individuals that are being hired today, a third to 50% are minorities, either women or minorities, and you can see the excitement people are having around the blend of folks around the table, as well as the contributions that are coming from those people. So it's something that I would, by the end of this decade, I think it will be less of an issue in venture capital. I do think there are other asset management categories that will continue to struggle with what the communities would like to see as far as diversity is concerned.
Any last parting thoughts for our emerging managers and young GPs? It's a marathon, not a sprint.
What I've learned over the years is the things that are most frustrating sometimes are the things that make you better. And that the other thing that's clear is it's never clear what's going to win. And so don't neglect anything. We've spent 20 years really building a lot of goodwill around our firm. And I remember in the 2007 timeframe when I was beavering away trying to help everybody raise money and all the different things we were doing, I thought either I was going to be the nicest guy in the world or the dumbest guy in the world. And 20 years later, I now understand what that goodwill looks like. So just be patient with it. It'll work for you. Sometimes you don't even know it's working, and it's working for you. So let it work. My pleasure.
If people want to get in touch with Top Tier, how should they do that?
I'm readily available either on LinkedIn or through my email address, which is dyork@toptierttcp.com. The door's open. That's kind of one of our customer service policies here. So if you don't get to me, you certainly will get to somebody. So don't hesitate to reach out.
Thanks, David, so much for being on Swimming with the Allocators with us.
Our pleasure. Thank you.
See you later, allocator.
After Portfolio Tile, investing with a smile.